All right, Vinny, I think we're live now. Okay, let me just find it on Facebook. Oh, now I can't hear you. Did you plug in that mic? Oh, hold on a sec. That's weird. No, can't hear you now. Uh, let let's try to.
I bet you can.
Yeah, I can hear you now.
Okay, beautiful, beautiful, excellent, excellent. So, sorry guys, all these debacles, technical difficulties. Life is to just roll with the punches.
Yeah,
Okay. you know.
yeah, that's how it works. Technology. Uh,
Yeah, that's so true.
okay. You have two properties under contract now, right?
Yes, yes, yes. Actually, we are very excited. Things are happening. We got, of course, the one in Orlando area. As you know, we got that 52 million one already closed. And then we are now uh, into. Okay, can you hear me okay? I just don't need to hear my Facebook Live.
Yeah.
So, okay, we are fine. We are fine. So, yeah, Beau, it's very exciting. We did the due diligence. Our PPM should be ready, private placement memorandum for the Princeton Park deal. And we are going ahead. Our closing is December 10th, a proposed closing. So, we are very, very excited about it. And we are oversold. I mean, it's always good to have that thing happen when you need to raise this much, but then so many people want to invest in it. That's a good thing to have.
Yeah, that's a good problem to have. Too much money, right?
Hey, I want to congratulate you on your developments that happened this week. I am so proud, and so excited how you have taken that direction and you have maximized your efforts in the main core business, and
Mm-hmm.
that's what happens when we totally tunnel vision ourselves into one particular thing rather than doing so
Hey,
many.
I want to congratulate.
Yeah,
Thank you. Thank you. Sorry, something popped up.
no problem. No problem.
Thank you. Yeah, since I know all you big apartment guys, it's only natural, and I'm a lender. It's only natural that I become the biggest and best bridge lender in the nation, right? Like,
Yes.
typically we're going to do million to $15 million bridge loans. We do have capabilities of doing $50 million deals, but it's fun kind of working. So we consider anything under 2.5 million small balance, and then anything above that is actually a commercial product.
Hmm.
So our bridge loans for the commercial, the bigger loans they're based on the 1 month LIBOR.
Okay.
Okay, so that's how all the commercial bridge money is for the bridge space, and And so then you'll be certain basis points over the 1 month LIBOR. I think the 1 month LIBOR is at 2%. So depending on the risk, the property class, the sponsors, all that good stuff, that's where you're going to be maybe 200, 300, 400, 500 over
Sure.
over the 1 month LIBOR. And so it's nice because I'm working with a commercial underwriter who's got like a lot of experience. So I'm actually learning, right? So it's going to complement me on the backside when I'm starting to buy more of my own multifamily units, right? I'm learning and also making money at the same time, which is great, right? And that's like hanging out with you and learning from you all these years, right? So that's what we want to do, is we want to learn and then execute and then take action. But yeah, so for years, I originally moved to Las Vegas in 2007, and the downturn happened, and I always said I need to be back in Las Vegas. Something about that town, it just fits me. It just fits me perfectly. And then also because I'm getting married and the cost of living is so much better there.
Yes.
Yes.
And no California taxes. Oh my God. Hey.
Yeah, no state taxes. And, looking at it from an investment standpoint, there's also, before it was a one-hit wonder. You had the entertainment, the hospitality industry, and that's all of Vegas. Now we're getting tech jobs. We have Amazon distribution center being built. The Raiders are going out there. Lots of jobs are being created. Job growth obviously drives economies. And now, when we hit the next recession, we'll have more of a leg to stand on, because we're a diverse economy that has multiple job growth factors. So I think that's good too. So I think when I'm there, I'm also going to be looking at multifamily opportunities. And
beautiful.
Yeah.
Oh my gosh, let's explore them together. I think, like you said, diversity is so important. In any kind of market where we buy syndication deals and apartments like that, because we want apartments to be packed, 90%, 95% full, and that comes from the households moving in, like you said, Amazon and other things, and Raiders coming. Lots of great things happening. Similarly, I know Las Vegas was hurt quite a bit in the recession, and so was Florida also, as you know. And I'm kind of bullish on Florida because a lot more things have come in there. Of course, the baby boomers are retiring more over there. Millennials are also like a lot of tech jobs, you said, retail, medical, a lot of other things than tourism alone, in Las Vegas and Florida. I mean, Orlando and all that, a lot more tourism there, right? Yeah.
Well, yeah. And also if you look at Nevada, Florida, a couple other the states, like Florida doesn't have state tax either. So you see a lot of wealthy people moving. That's why people live in Florida. That's why people live in Nevada, because they want to get around that. And those are great places to live.
Sure.
So that also drives the economy, I think, too. And so, yeah, when you're looking at all this, I think you're seeing a shift with the baby boomers, because at some point, unless you have just too much money, you got to do something, because it does. If you're not, if all your wealth is in your house in Danville and it's worth $3 million or $2 million, yeah, $500,000 or $600,000 in the bank and mutual funds, and you're used to a certain lifestyle, it's not going to be able to be sustainable in maybe the Bay Area unless you're a high income or a high net worth person. So that's the people that I think are moving to places from New York. They're moving to Florida. From California, they're moving to Nevada or Arizona or Oregon. You're starting to see more shifts like that.
Sure.
I mean, California, I think will always be California, because it's the hub of Silicon Valley. It's the hub of entertainment. Although now Atlanta's getting the entertainment business up. So I don't have a crystal ball, but the interesting thing is when I booked my U-Haul from the Bay Area to Las Vegas, it costs way more money than Las Vegas to California. So what that says is that more people are leaving California, so they charge you more because there's more demand going out than coming in. So that's
that tells you a lot. No, you're so right, And of course, the key thing is California will be California. I mean, a lot of time people thought that with earthquakes, we might join Hawaii. fell off and joined Hawaii over there, become an island. But you know what? I mean, what it is, right? The key thing is for all of us to really see the risk that we can take for rewards, right? And then, of course, as the baby boomers, 72 million, by the way, wow, a large, and millennials, that's another 71 million. That's 143 million. They are liking to really, be comfortable, of course, and also live into apartments, to be truthful, because what we are finding is that a lot of the millennials, they're making more money, more buying power, but they're liking amenities and, they're liking to be living in luxury apartments, let's say that, B plus and A, communities like that. So again, I think we are strong, we are strong in wherever we go, where the jobs will be, there. Again, have you heard much about the correction? Should we talk a little bit about it today? What do you think? What
Yeah,
happened?
we should. But I want to just tell you an interesting thing.
Yeah,
So,
please. Yeah.
so I had a bank that was doing my loan to purchase a home, and they completely screwed me over. And basically, they're giving me my, without me having to sue them, they realized they really screwed up. So they're refunding me my earnest money deposit. So
Yeah.
that put me in a bind. So basically, I had to rent an apartment. And here's the interesting thing. So I was like, okay, I just need a temporary stay until I find a new house.
Mm-hmm.
So I was Googling, I found this place, and I was just really impressed so far. I haven't seen them, only them pictures, but what was really neat about it is I don't know, it's probably a 250 unit property in Las Vegas in a good part where I'm used to, where I know the area very well from the previous real estate I've owned.
Yep.
And what I like they did is most of their units are unfurnished, but they have a selection of furnished units. So I could have rented so I just went in for, you could do it month to month.
Yep.
So I went in and I did a furnished rental, and I had the option of doing a 1 month or 2 month or 3 month. If you did a 3 month, it was a little price discount, but I really only needed it for 2 months. So I did a 2 month, which was a little bit cheaper than the 1 month, obviously.
Yep.
But it's fully furnished. All utilities are included. I think I'm paying about $2,100 a month for this. Now that unit, without being furnished, rents for about $1,100 or $1,200, right? So they're getting almost double the rent, right? So taking that into account, if you're in an area that you can take, if you have a 300 unit built like this Bentley project, right? Like, could you do a case study and get 10 units and furnish them, and then run it like this company's doing it? How much would that affect your earning potential? And then also, are the Fannie loans out there, will they have issue with you doing partial rentals when they're underwriting the file for a refinance? Like, because some lenders have issue with short-term rentals, but I'm thinking that if it's a 30-day stay or longer, it doesn't really matter to them, as long as at the end of the year they're using the rental income, right? But if you could, I guess the point is, if you could supercharge by doing that in areas like where Bentley is, and you have, out of that 300 units, let's say, I forgot how many units it was, 254.
324. Yeah.
324. So if you had 40 of them that were furnished, right, and you could increase revenues by, whatever that X is out to, which then in return increases the value of your property another $2 million.
So true. So
right?
true. Oh, it's very, very possible. And we are doing it. We are trying to do it with like 4 units, as we discussed, because the thing is, we want to do it slowly, make sure there is market for it, right? Which there's a very big business park. A lot of people come in. They would like to have it short term. Of course, most of the, real estate people like us and our management company, we go for 12-month leases, right? We want them to be there because there is a turnover fee also, like we call it. Once somebody leaves, how well they kept that apartment. So we have to do a case study, like what you said, $1,100 more, maybe in that fee, which they are charging higher, they have kept a little bit make ready maintenance stuff in there, and the rest is their profit. You're right. No, it's becoming very popular, very popular. We have done it in Texas, by the way. We
Yeah.
did it in Lake Jackson. You're right. And I could furnish the whole thing. Can I say something? For $2,900, and these were the companies, they will bring their furniture and, for 2,900, I could do the whole thing and I could, get about 1,400 or so extra dollars per month. So within 3 months, it paid for it. And then after that, it was gravy. So,
Right. So let's say at the end of the year,
yeah.
that unit, instead of making 13,900 in rent, it makes 21,000 net.
Mm-hmm.
Or, right? Like if you really look at that, and then you have 40 units like that, and you're taking into account that you're not going to be day by, because there's going to be a little bit of a gap between.
Yeah,
Sometimes there might be a 5 or 7 day gap, but
sure.
really, I think in some markets this could be a real game changer for increasing net operating income by
Definitely. Definitely.
significantly, because you're really not going to be doing as much. I mean, they're furnished. You got to go in, you got to clean, and maybe do a little touch up, but that's about it. I mean, because
So,
most of the things that happen are when people are moving in beds and stuff. You're not dealing with any of that. You're just dealing with normal, clean the shower, and some mildew
so
and
true.
right. So
True. Yeah. They're there for a short term, like you said, Beau. And also, it's like an alternative to hotel. They're able to live in a good community and be near to their place of work, like you said, those kind of things. You're right. No, it's a Airbnb concept into the apartments, right? Rather than in the homes or like that. But that's a pretty big one. I don't know about the lending side. I do know our, broker was asking, uh, to be truthful, in our calculations, we don't really put it in the equation, to be truthful, because probably for Fannie Mae, Freddie Mac, you mentioned it, they're the big arms, that give non-recourse loans in this
yeah,
country. And I think they might be frowning upon it. I didn't really ask, but I know majority of the time they're looking at, how is the demographics and who are the, people who are living in the complex. Yeah.
yeah. Well, I think at the end of the day, the people, the operators that are innovative,
Yes.
right? Even in a market now where you're not going to get the same probably run up you did from 2013 to 2017, right? We were in a huge boom, right? And let's face it, we're not in that same boom anymore.
We are not. Not at all.
So what can you do to force the most appreciation into this apartment, right? And so people, it's all about disruption. Like Zillow's gonna, they're saying they're gonna be buying 5,000 homes a month now, single family homes, right?
Wow. Just like open door. Just
Yeah,
like open door, I think, they're bringing the similar concept.
yeah,
Wow. That's amazing. You're so right. I mean, they're able to buy and then sell, just like what we are trying to do. Brother, if I can plug it a little bit over
yeah,
here in the Silicon Valley, Vinney Chopra and Beau is there too, and Devon and other people, David and, Deepak and all of us. We are starting a new company. I wanted to kind of mention it today since you brought it up. It's called Oxygen. And what we are trying to do is to take the sellers on the left side, combine them with the buyers on the right side, right there, frictionless. There is a lot more challenges on the buyer's side usually, and also on the seller. And we are finding it's like antiquated. It's become a very, broker kind of, big boys network, we call it. But we are just trying a small portion to see if we could really find the right sellers and offer them great price, fair price, and buy the property multifamily within 2 weeks. Within 2 weeks, all cash, and then we'll be able to find the investors. There is a bunch of investors, very qualified, who will be able to take over the asset. So that's the new concept. If anybody's interested, they could reach out to Beau or to me, through this podcast. Yeah.
yeah. I mean, I think if you look at everything that's going on in our society and especially in the real estate world, where we live.
Yes.
Things are happening so fast because of technology, and people are able to scale. And even if you look at my business, the lending, the hard money lending, the bridge lending space, before it was local funds that were going out and getting accredited investors. Now we have institutional capital, and people, it's grown like 100x in the last 8 years, this business. And that's happening in the space with Open Door and Zillow, and soon to be in the multifamily space. So what I've really thought about is that if you're the little guy, you really gotta, now's the time you gotta really step up and figure out how you can make money with all this disruption going out. Because if you're not innovative, you're going to be gone, I think, in the next couple years, right? Like a typical, a standard real estate agent, that process of being an agent might look completely different in 10 years. It's going to be maybe a different process. Maybe most of it's going to be online. Now people are able to let themselves into houses with their iPhones.
Yes.
So there might be where there's somebody working in an office as an employee that's coordinating the paperwork.
Yep.
And things are done less, instead of people getting charged 5 or 6% commission. Now it's done way less cost. And so if I'm a seller and I'm getting the same price I would by listing with an agent, instead of 6%, it's only costing me 2%, and I'm getting more or better service, why wouldn't I work with this Zillow, right?
Totally.
So that's kind of like what's going on in our world right now in real estate, that there's so much disruption going on. And that's why, like you, for example, or syndicators in general, right? They figured a way of disrupting being a real estate investor, because if you just went out and tried to buy an apartment complex, you could be the best buyer and best deal finder, but you're limited on the capital, right? You're only going to be able to do one deal.
Yeah.
Or you're on Bentley, you had to raise $16 million, and most people don't have $16 million laying around. So syndication is a disruption, right? Because before there was syndication, there was 2 or 3 people putting money together and buying a small apartment complex. Then it's like, well, no, we want to raise money from people we know and we can build relationships with. But we got, sometimes now, if you do the right different offering or securities, you can advertise to the masses, right? So you can go out there, you can do internet marketing. So now that disrupted the multifamily. It's not just for these big REITs that it's for the average guy that takes the time to learn the business, to study the business, to find good deals, to find out how to operate and manage these things. So everything is disruption, and that's why the human race has evolved so much, right? There's so many smart people out there, and then over time, people learn, right? People learn from mentors. Like you had a mentor, now you're a mentor to other people, right?
Yes.
So that's the ongoing process of what's happening in our world. And for a long time, I was sitting on my thumbs and didn't, think about it. But if I just look at what happened in my bridge lending world, what happened is Wall Street figured out there's so much money in lending money that they got into the business. That was, they were never in it before. And over the last 6 years, now it's all institutional money.
Wow.
And so, so a lot really has changed, and a lot's changing with multifamily. A lot's changing with the way we buy and sell houses, and it's going to continue to change. A lot's changed since the old days where we'd have to, flag down a taxi cab. Right now, we can just use our phone and we can get an Uber. So what's happening? I think as an investor in real estate, you have to look at these trends that are happening, right? Like, and what's happening with millennials, or like people like that sell houses. Where are they going to go? They're going to put their stuff in storage. They're going to live in a furnished rental for, a month, 2 months, 6 months, a year. till they find a house as they're relocating.
Hmm.
Or a lot of people for their work, they get put into a new city for a year, and they need a furnished property for that year. And that's why these disruptions are working. That's why Airbnbs is working, because somebody didn't want to stay at a hotel. They'd rather stay at a residence or an apartment or a house. And now you have the ability to do that through Airbnb and those various websites. So there's so much disruption going on. It actually scared me, because it's like, I realized that if you're not with it, you're going to get passed. And if
Yeah.
you, and
So
right, if somebody else is going to do it if you're not there. So that's, as a small investor, we got to figure out how we can make a living against these big boys. These, even like how I advertise to buy houses, right? There's these huge franchises that are spending thousands of dollars. Now Zillow's buying houses direct, Open Doors buying houses. So we didn't have that competition. Now, as a home buyer, as a professional real estate home buyer,
yeah.
you have to be innovative to outsmart those guys, and they've got hundreds of millions of dollars, and they got the smartest engineers working for them. So that's what's happening in our world. So I think we all got to wake up and figure out how we can win in our little fish tank.
So true, so true. Yeah, what you're talking about, Bo. I mean, the thing is, you got to change. You got to change our thinking. We got to understand and research with the data. I mean, so much data is available now. Everything is watched by so many different companies, and there are data after data. The behavior, the artificial intelligence. Of course, we talk about the capital. There's so much money out there in the hedge funds and Wall Street, like you said, 26 or 27 trillion with a T, trillion dollars in retirement funds. So all those, many of the family offices and retirement funds and hedge funds are becoming banks, like you said, and they're investing money in infrastructures and in real estate and other places like that. The other thing is, the technology has improved so much that we are able to design these special programs where you could do the things with a lot of efficiency, I should say, very cheaply, and also you can manage things sitting in your office, sitting on your iPhone. I mean, you could literally run your business from iPhone, iPad, iMac, or Windows, of course, Surface, and all that. You don't have to travel anymore. I mean, Zoom meetings and other meetings, all that stuff. But the big thing is, if we can combine technology, the data, and the money, the warehouses of the money, that can change any kind of spectrum. Another one which I wanted to mention today, which I'm very excited and happy with Anshu, my partner, is about cloud security. Oh my gosh, that's the other startup we are doing in the Silicon Valley right here. And if anybody who's listening to us would like to get some prototype in their company, we would love to come and share with you how you can save millions of dollars in the coding and the problems and everything by finding out where the breakdown in the security will happen for them. And much before, it's like 7 times more cost if we find out later on than what we find out first, where we are doing this startup at. So it's going to be very exciting field. I'm very fired up about lots of different things. You got to change. I'm doing very well in the apartment industry. I think another one grabs my attention is hotels. So we'll look into that. But the thing is, we want to really explore these avenues to make us grow, right? Everybody should be thinking about growing, and those things are there for us to be looked into.
Yeah, no, I think you always gotta evolve, you gotta grow, and
Yeah.
now for you, it's more about your passions, right? You don't necessarily need to work or need to buy more apartments. But you love the business. You love finding the deals. You love raising money. You love putting the deals together. You love giving your investors a good return. So that's your passion. And so right now you've got a lot of momentum. It gives you your energy to wake up every day, right? Like if you didn't have this anything to do, what would you do? You'd go play golf at Blackhawk.
Maybe, yeah, yeah. Watch TV or, and get into trouble and all that bad stuff. No,
Yeah.
golfing is good. But the key thing is, to really enjoy life is the key. And when you have passion or some vision board, we call it, right? And we say that we want to make a difference in the lives of people around us. That's when you get up earlier than before. When you have a W-2 job, I mentioned that many times. I used to get up at 7. Now I'm up at 4:30, 5 o'clock, 5:30. Just so excited to, see what I want to do today. Things like that. You're right. Yep. Yep.
So let's talk about your outlook going forward with the economy. I think everybody's kind of got it in the back of their mind. I know personally, I've kind of been shocked that our economy's been thriving for as long as it has.
Yes.
And maybe it's because I got clobbered in 2006 and 7, 8.
Yeah.
And I don't want to feel that pain again, right? And I think a lot of people, our world works on emotion, right? Our economy is emotion based. Like if people start thinking the housing market's going to sink, right? What do people do? They go and everybody puts their house on the market, right? And then all of a sudden it causes more of a problem because you have 3 months of inventory. Now you have 9 months of inventory on the market, right? It's going to cause a natural decrease in pricing. So I think a lot of stock in real estate sometimes is fear-based, as far as single family and stocks. I'm not talking multifamily. Multifamily, you're buying a cash flow stream. You're not really in a short-term window. You're in a business of, hey, this asset is going to pay me cash flow every month. It doesn't matter. It's not going to comp like a house, that's sold next door. It's going to comp on what the cash flow is.
So true, Beau. What you're saying is so right. Again, I would like to, inject, and a lot of people who are listening to us, I'm sure they feel the same way, that, the economy has taken a big bull, as you know, from 2008 to now, 11-year bull, but the parameters were very different. If we look back, we used to have stated income loans. We used to have people having 10 rentals because, or even more than that. A lot of time we bought homes by not putting any money down. If we go back that many years back, you got money to buy a house. Where do you know about that? Without any equity. But then the other factors were that apartments per se, I can say, they held on, even though the economy shrunk and people who lost their lovely homes, or they needed shelter over their head. So the people moved from single family home into apartments to, make their, life work and so forth. Or when husband and wife, if one person lost their job, they couldn't afford the A class apartment, they went to B class, or B went to C class or D class, like that. So the delinquency rate, foreclosure rate was very low in apartments. That's where the norm of the industry is thinking. In real estate, in apartments at this time, there is a big, conference going on in LA. This just finished, I think. And, again, there is a big synergy in saying that, the demand for apartments is there. And it's increasing, by the way, because millennials are liking to live in portability mode. They are liking more apartments, luxury apartments like B plus, kind of like that, if they can afford, with amenities like big. I'm thinking about cyber cafes, and of course the exercise. Big, nice, great machines in the exercise rooms, and the swimming pool, and the spas, and the hot tubs, and the dog parks, valet trash, things like that. So I think there will be correction. My thinking is, yes, nobody's got a crystal ball, But if we are able to pressure test it, that's the word we are using in my syndication deals. We pressure test it for 30% vacancy, 30%, 30. Even though the product we are buying today, it's 97.5% occupied, the one we are buying. But in our underwriting, we are pressure testing it. If we lose 30% of the people from 324, that's how almost like, you're losing, 30%, 100 people just leave. Can we be surviving in that downturn? And the answer is yes. See, that's what it's all about, If we can make the mortgage to the lender, and we may not be able to give the cash flow to the investors, but we'll be able to ride the system, it's called, right? Ride the wave at the bottom. They're thinking it'll be shorter also, by the way. I don't know why. It was longer, 2007-8, it flowed into, in some areas, even 2 years, by the way, recession. Then it came into recovery. But many of the people are saying where the jobs are coming and so forth, the bump will be smaller, maybe a few months.
So, interesting question. So when you guys are underwriting a deal, I know banks and so forth look for a 1.2 debt service coverage ratio, but what do you guys, when you're underwriting your deal, what's your number? What do you target?
Okay, the one we are just buying now, 35 million one, our debt coverage ratio is 1.89%, 1.89. So that's interesting. Why we are doing that is that we are going with a 30-70 LTV, 30% equity down, 70% loan, rather than 80-20. That's also a good hedge for the downturn, because if we have more equity into the deal, our loan is less and our payments are less. And we are also going for fixed interest only loans, interest only for 5 years. In other words, we don't have to pay down the balance until the 6th year. So that's other thing we are doing, Beau. In other words, we are hedging it several different ways. First of all, there has to be a good value play in the property. What that means is, if there is mismanagement, or if they have not done the RUB system, which is the ratio utilities bill back system, or they are starting to do it, we project it out and see how much more we can do up to the total expense of the water, trash, gas, and pest control. That's one thing. The second thing is the differential of the rents compared to the other properties nearby. So the one we are buying, Princeton Park in Orlando, in Florida, there is a bump of $300. Oh my gosh, $300 to $400. While we were doing the due diligence, they even increased the rent on some families who were living there in that community by $300, and they didn't even say anything. They said, sure, I know the rents have gone up, but just the previous owner had not increased it yet. See? So sometime when the occupancy is 97, 98, 99%, it's a high time to look at and compare the rents all around. You might be the lowest. This is 2003 built property. But the exciting part is that it's a beautiful, beautiful property, and with a lot of great amenities and so forth, So we do pressure testing. We do low LTV, I should say low loan to value, 70%. And then interest only for 5 year, it's 10-year fixed loan, 30-year amortized. And then we are raising money also from the investors to do the renovations. That's the other thing. So we don't have a bridge loan. I'm sorry about that. But the thing is, because we don't want to be in a situation 3 years from today when the interest rates are higher. And then maybe they will be higher or lower. Nobody knows it, And the thing is, we are getting 3.7% right now fixed for amortized over 30 years, 10-year fixed, 5 year of interest only. So we are very happy. So we can raise more money from the investors right now to do the renovations, like 1.7 million we are raising already. And that way we can invest that into the property, the units that are not upgraded yet. And that will give us the bump of $300 to $400 per month per unit. So a lot of things. As a shrewd syndicator, you have to really look at a lot of different angles to really decide, is this the right property or not? And remember 2018, I didn't buy a single one. Did not buy a single one. I underwrote hundreds of them, and best and final, but people were overpaying and overpaying and overpaying and getting into trouble. That's what I thought, which is true. At a higher interest rate, interest rates fell actually in 2020, and there might be just 20.25%. We just had one this week, right? Basis down, and there might be some more coming up next year. I heard maybe 2 more downturns of interest rate.
Yeah, no, I like what you just said, because you guys put a lot of thought into how to structure this last syndication, right?
Yeah.
And I think a lot of people are always trying to get the highest leverage possible from the bank, but obviously what you said makes a lot of sense to me.
Sure.
Because you guys don't have a capital raising issue.
No.
You want to do what's strategically best for all the investors in the syndication, right? And I believe what you just said makes a lot of sense.
Sure.
And with if you can get a fixed product in the high threes, 3.75, I mean that's unheard of, right? So you got to take advantage of that.
Yeah.
That makes a lot of sense. And with this property being able to bump rents 300 to 400 per unit, right? So there's also probably a strategic way of doing it, because if you go to the highest extreme, people are going to look around and say, okay, well, I can just go move into this one, which is a little bit newer. So you've got to, so there's an art to, like, okay, what are we bumping rents? How are we going to bump rents on each unit to maintain as many as we can? You're going to have some turnover.
Yes.
Whenever you bump, right, you always factor in a certain amount of turnover based on the rent bump, right? I mean, I don't know how you guys formulate that.
Only 100 to 150, even though we know, Beau, that it can go to as high as 400. We never go to the extreme at all. We only planned it only in the second year that we might be able to bump it by about 100 to 150 after renovations. So we just don't want to go to the highest level, because that's not right choice. That's not, because it's all projecting. We like to under promise and over deliver. That's how our whole companies are built. Transparency, under promise, over deliver. And that's why our investors love us. And then they want to, when we sell the property, they get the gains, they get their initial money back. They want to say, hey, what's the next one? What's the next one? So it's good to have that kind of thing. Under promise, over deliver. Yeah.
Okay, here's a question I've been thinking about. What's the best way to make sure when you're buying a new asset, obviously every state, every city is a little bit different, but how do you account for property tax? Like the previous owner might have bought it for 20 million, 10 years ago. Now you're buying it for 35 million, right? And so you got to be careful that how each city and state assesses property taxes based on that property, right? I mean, so
100%.
So how do you what's the due diligence on that to make sure? That's a huge problem.
I'm so glad, Beau, you're asking, and that's the number one thing I teach in my academy. That is the biggest thing. I like to find out the story behind the property we are underwriting and looking at, doing due diligence. And you are so right. We need to go to the current mill rate, MILLRATE, current mill rate of the county. Wherever you are purchasing it, you've got to go to the assessor's office, that's where it is, mill rate, and find out what percentage of the purchase price you have to multiply. Is it 40% like in Atlanta, Georgia? I found it was purchase price times 0.4 times the mill rate was higher, like I think 3.5 or something like that. In Texas, mill rate is like 2.42, but then they take 0.8%. So we need to be looking at the new taxes. Otherwise, it's going to be a huge, huge problem if you calculate the taxes wrong. Insurance and taxes. Many times we see many of the owners have portfolio insurance. What does that mean? They have an insurance that covers all their several different properties, and they allocate a portion to the property they are selling. So the lower insurance rate can stymie you, conflict. You should ask a commercial broker to get the insurance rate for that particular asset, and also get the correct taxes. Those are the two things that kill you, by the way, in the deal, because sometimes you take, okay, let me take the same taxes, what the, in our owner paid. But you're right, Beau. If we take the same taxes without looking on the current mill rate and the ratio, we could be in a lot of trouble.
Very good. I mean, this is why we do the show, is
Yeah.
because a lot of people just don't, they
Yeah.
get through things and they don't really think about certain things. I know, like here in Oakland, in certain markets, on our single family homes, we have a county transfer tax and we have a city transfer tax.
Yep.
In some cities. So Mario was buying a property, and when I was looking at the numbers for him, I'm like, dude, on your contract, you're paying, you the buyer are paying the city transfer tax, and that's $15 per thousand, man. That's an extra $8,000 he wasn't aware of. He wasn't thinking about.
Yes.
Right? We gotta know. We gotta do all this due diligence, and like you have a checklist, 271 things.
Yes. Oh, huge.
Everybody should have a checklist when you're buying these properties. Everybody should have a checklist for the first 30 days of action steps. Everybody should have a checklist of property management review, 90 days out.
Yes.
Right? Because that's the only way you're going to miss something, because there's so many moving parts. But once you have these complete checklists built, you can actually systematize it. And that's how you're able to do what you're doing right now. It's because you built teams and you have systems. If you didn't do that and you were one guy, you weren't doing what you're doing, right? So that's the mindset. He's working on his business, not in his business, right? And that's kind of the big part. Because I always look at these really successful people and I go, how the heck did they build this, right? You have to have the infrastructure in place, but you actually have almost more time on your hands now than you did 15 years ago, right? And you're making 10x the money. It's just amazing how it all works, right?
So true, Beau. I mean, I remember when we were starting out 14 years back, we were into everything. I mean, we were doing it, packets together, putting up graphics. I mean, I didn't know much how to do it, all that, so you're spending a lot of time in the $10 job rather than $100 or $200 job, right? Per hour job. So that's when you build systems. And then the systems, the people, the teams are the ones you hire, people who are professionals in your, in the kind of expertise you want. And that's why we are vertically integrated, we call it, because we not only acquire, Monil Investment Group acquires, but Monil Management Group manages also all the assets. And then my teaching academy, multifamilyacademy.com, where I teach also how to analyze deals and how to, practice and how to, qualify for loans and all that. And then how to syndicate and all that. I'm not an attorney or a CPA or anything, but I'm a broker, California broker, but I never really bought and sold, as you know. But the key thing was I just took it into a new way to be an investor,
So this is what maybe our next call, we should maybe go over the checklist. I think that'd be kind of cool. Just like,
yeah.
And we could kind of talk about things.
Narrow it down to, where it's more respectable, maybe 50 items.
Yeah.
Because I've been using that list, for many, many, many years. I would like to simplify things. But you're right. It's so important to know what to do 30 days before the closing, at the day of the closing, and then after the closing, right? So we'll go over that. That'll be amazing. Yeah.
All right, great. Yeah, maybe we'll do a Zoom call for that so we can do a better screen
Yeah.
share, and then I'll send it out through my meetup, and people can just register and go to it, and then
Amazing.
we can share it later on Facebook.
Let's do it. Let's do it. That'll be amazing. But also I wanted to, before we wrap up, wanted to mention to all our audience in the Bay Area that I'll be Sunday. I'm in Los Gatos over there making a presentation with Gaurav. Really great guy, and whole group with Rama and everybody, Krishna over there in Las Vegas, and then of course with you and Bobby Sharma. We are down Monday, Tuesday, and Wednesday night in San Mateo, I think, and then San Jose and San Francisco. So please look on the Facebook page. We'll put that ad again. Come and see us, and we'll be raffling off some of my books. I don't have a book. I usually have my book here somewhere, but that will be raffle off some of them, and I love to answer lots of questions and get to meet a lot of people.
Very good. Well, I'm looking forward to seeing you before I leave town.
Yes.
You'll have to come visit me in Las Vegas.
Oh,
but anyway,
I'll be there, man. We'll enjoy some and see some good shows there, and it'll be fantastic. We'll have a home there, and you're getting married. Congratulations. That is going to be fun. We can have some good cooking also. I know you're a great cook, so and take your bride out. That'll be wonderful. You bet. Yes.
All right, guys. Well, thanks for watching. We'll see you next week.
Thank you. Thank you, Beau. And thank you, everybody who joined us today. Remember to like us, to give us comments and share it, and put notifications on, if you will, so that you don't miss this show. And we want to make it for you. This is Vinney and Beau show, but it's your show. It's not our show. So please tell us, what would you like us to discuss? How you can take your business to a new height. It's a combination of real estate, personal development, motivation, you name it. So thank you again for watching, and please look at the book. My new book is coming out. Positivity brings profitability, should be coming up soon. My audio version of the book, which became international bestseller, is out also at Amazon. This way you could be listening to me, not me, but we hired a professional to read my book, and that'll be great to really understand the concepts in your car. And then my podcast, which is Syndication Made Easy, my sequel, getting great reviews. I think I've got 375 reviews already. I'm totally excited, 4.7 ratings. And then also my Mr. Smiles Motivation Talk Show. I'm very proud. I will have guests like Gino Barbero on with me next Monday, and also Reed Goosens, who is also a great, great podcaster and a great investor on my show. We are looking to get some very big personalities on my show also. So thank you so much. We appreciate you.
All right. See you guys next time. Bye-bye.
Thank you. Bye-bye. Bye-bye.